In this webinar, we're going to discuss the 3 common items that are in every successful business sale. There's 3 common items that businesses will have prior to going to the market. We're going to discuss those and illustrate items that you can do to help get your business ready for sale, whether you're looking to sell it on your own or through the services of a professional business broker. With that said, let's go ahead and get into the webinar. The webinar itself, feel free to take notes and ask questions. We'll have some links below that you can send some comments if you like, and some general follow-up questions of anything that you might have. But the most important thing that we wanted to discuss in this webinar is 3 common characteristics that we've seen over the years of selling businesses. Now, we've been selling businesses for over 15 years. We've sold everything from large-scale e-commerce companies to the local corner pizza shops, manufacturing companies, landscaping, dental labs, and a little bit of everything else. Although each business sale is unique in nature, there were common traits and common metrics that were in every business that actually sold. Now, before we go into those 3 metrics, I want to illustrate one thing that's a very common knowledge in the industry, but not so much outside the industry. And this is what it is. According to statistics that you can find on most business for sale websites, go to the SBA, you can find these also. Almost 80% of all businesses that are offered for sale do not sell. Out of all the businesses that are available for sale, only about 20% actually sell. And of those 20%, they can even be whittled down a little bit further, because that would include fire sales, things that don't sell at full asking price, etc. So, although those factors cannot be completely determined, as a guesstimate, it's around 10%. So how do you get into that top 10% where, number 1, your business sells, number 2, you get a fair or premium price for that? These were the 3 common characteristics. Number 1, is the business worth buying? Now, really think about this. Businesses in general are cash flowing machines. There are different variables on all different scopes of businesses, but for most Main Street to lower middle market, and that is qualified as basically the owner-operator businesses, up to about 25 million in revenues, some in that realm. Those businesses are normally purchased for cash flow to the owner or owners if there's more than one owner of that business. If you're watching this video, you may own a business, or you might know somebody that has a business, or maybe you're just curious. But if you own a business, you probably started that business or purchased that business with the hope of cash flow. Not just because of what is going on in the business, but for items that you can actually do in that business. These items are what drew you to that business. The same is going to hold true with when somebody's looking to purchase your business. People normally will not purchase a business based on opportunity or possibilities of future or assets. Although there's sometimes people will buy assets of a business, but not so much take the liabilities of that business. That's a whole nother webinar and video that I'll do at another time. But for most people that are looking to purchase a business, they're buying for the cash flow. Now, taking that a step further, how much does that cash flow need to be? Is just being profitable enough? Does it need to have profits that are growing year over year? Each one is a little bit better. But for most cases, people are looking to purchase a business that can sustain their current state of living. Each person's different. So to one person, $50,000 a year might be a lot. Another $500,000 a year may not be enough. So it's individual based, but the moral that we're trying to get across is that all the businesses are looked at on a cash flow basis. Now, on top of that, it's not just the cash flow, it's the time invested to get that cash flow. So if you have 2 businesses, both making 100,000 a year, and one requires you to be there 100% of the time running the full day-to-day operations, and on the other end of the spectrum, the other one has a full-time manager where as an owner, you don't need to show up or maybe just work on some of the larger aspects of the business. One is going to be much higher demand because of the time invested. That'll be reflected in some of the premium multiples, but in and of itself, the time factor and the profits of that business are basically the very first caveat, the very first step of even thinking about selling a business. Without this in place, without having a business that has cash flow and maybe some leverage of time or a manager in place or some type of employee structure or outsourcing or freelancers that can run a lot of the operations, the business probably should be looked at to be improved before taking it to market. Now, there are times that you'll just do a fire sale or a quick asset sale. That's a completely different topic. But selling it as an ongoing business, as a going concern, and looking to have a premium of pricing and maybe even competitive bids to purchase that business, you want a business that has positive cash flow, growing year over year, that has cash flow that is in excess of what that area is that people are looking to purchase, and also has the time value that people don't have to work the 100% of the day-to-day operation. It can be outsourced, or the business cash flow can sustain the cost to hire a manager or an overseer, freelancers, etc., to run those day-to-day operations. So that's step number one. Step number two that we see as a common denominator in successful business sales, and some that sell at excessive premiums, is the financial reporting. The financial reporting on most businesses nowadays is pretty up to date. With things that are available, such as QuickBooks or Xero accounting software, or even something as simple as an Excel spreadsheet, there's ways that most people can use those financials to keep track of their day-to-day operation. But here's the catch. Those items need to be reflected on your tax return. Now, before I start getting a lot of comments from others in the industry and other professionals, understand what is reported on a tax return and what a business actually nets for the owner as a whole, collective whole, are two completely different things. You'll have a taxable base that'll show on your tax return, and then there's a recast that'll happen when you look to take a business to market. That recast is a fancy word for basically just saying, what is the true owner benefit of everything that is benefiting the owner of that business? So there would be a taxable base, which is sometimes referred to on different terminology depending on the point of view that's being looked at. Some will look at it as an operating net, taxable net. Some will look at tax returns or different types of income statements and look at EBITDA. There's different viewpoints depending on the people that are looking. But overall, there's what the business makes, and then what expenses are being expensed through the business that are really owner benefits. Other things that will happen are one-time, non-reoccurring activities that are being done in the business. As an example, you might have a reserve for replacement. Let's say you have a landscape company and you had to replace all the equipment in one time. That is not an ongoing expense, although it needs to be factored in on an amortized basis. There's different ways that those will be reflected in those finances. But if the business made $1 million in profits and then you spent $1 million in equipment, it's not that the business made zero, it was re-put into the business. So typically that would be an add back to some percentage value. Also, was there any interest or depreciation that's being through the business? Healthcare, any owner perks, travel, leisure, entertainment. These are some of the common items that will help on a taxable basis, but will on paper look like the business is making less when actually it's just expenses that are running through the business. Now, these items will mostly be reflected on your tax return and your income statement. They'll show two different items. Now, on top of the income statement, you want to have a balance sheet. It's getting a little bit ahead of ourselves here, but you want all those things to match. This is a whole nother topic and a whole nother webinar, but in a nutshell, you want to have the financial package, which will include your balance sheet, your income statement, with those that reflect to the tax return. One of the main reasons businesses will not sell is inability to have provable and clear financials. When you have all of your expenses and all of your items listed on your tax returns, which legally you should do anyways, those items should cross-reference to your financials that are for internal reporting, and then those can be presented to a potential buyer during their due diligence so they can actually ascertain and verify those claims of those profits that we use in step one. So that's step two, having clear and articulate financials that can actually help solidify those claims of your earnings that you made in number one. Number three, and this is a big one. Not as big as the first two, because it's still possible to sell a business without this. However, the odds of it selling are dramatically withered in absence of this, and that's simply financing. Almost all businesses that are sold in today's marketplace on the Main Street to lower middle market level are done with some sort of financing in place. There is a wide range of sources that this can be accomplished in, depending on the point of view, whether it's an individual, a group, a trust, a team, a private equity group, a bank, a publicly traded company. There's a lot of different avenues that this can be done. But for simplicity of this video, we're going to talk about the two main items. And the two main ones are the SBA 7A program. There's also a 504, but 7A is what we're going to talk about here in this webinar. And the other one is seller held financing. When you have both of these items available, and you have these available before you go to market, you astronomically increase your buyer pool. In fact, almost 80% of all businesses that are out there that do not have financing in place don't sell. Remember when we talked about previously 80% of businesses that are offered for sale don't sell? There are different factors, but a lot of those are the inability of financing. That inability of financing by a bank is going to normally be because of item 1 and 2 that we discussed earlier. Is the business profitable? If it's not, a bank will not loan on it. Makes kind of sense, right? They're in the business of loaning money and hopefully getting it back. So that is, pretty elementary stuff. But the financial reporting has to be there to verify all those claims and able to do that. So with those two items, financing becomes a possibility. Now you're going to a market and saying, okay, here's a business that makes money. Here are the finances that prove that it makes money. And here is a bank that's willing to lend on number 1 and number 2, so you're able to purchase that business. Now let's look at it from a buyer's point of view. Let's say, as an example, we're selling a business, let's go on the lower end of the scale, $500,000. Now, $500,000, yes, it's a lot of money. And when you think of that, if somebody has to buy that business all cash, how many people do you know that have $500,000 liquid to purchase a business? Now, keep in mind, they're probably not using their last penny to buy a business, so they're probably liquid for even more than that, but at least they have to have $500,000 if it's an all-cash purchase. Probably not too many. Now, with the SBA 7A program, keeping it very simplistic just for the purposes of this webinar, business sales can be done 20% down, and of that 20%, sometimes the bank will allow what's known as a seller carry or seller standby note that will encompass 10% of that 20%. So there are times that a business can be purchased with as little as 10% down. So using that $500,000 example, how many people you know have $500,000 liquid, and how many people you know have $50,000 liquid? Even though that just seems like a 10-to-1 ratio, it's astronomically higher. You just increase that buyer pool by an enormous metric. Not only that, but people that actually have the funds to purchase will sometimes, as long as the financing is favorable, as term as rates, terms, qualifications, ease to get it, etc., will look to purchase with the least amount down also. The reason why is it increases their internal rate of return. It gets a little bit more complex, but think of it as a business perspective. If you bought a business at $500,000 and hopefully grew it to $1 million in value, you increased your rate by 100%. Once again, keeping it very, very simple. There are a lot of other factors, but just for illustration. If you did that with $50,000 down and you increased it to $1 million, that is much, much higher than 100% return on investment. It's almost 2,000%. So just from those aspects, even people that have the financial ability will most likely look for financing. So when this is in place from a bank and it's available prior to going to market, you have just increased that buyer pool astronomically. That's one of the reasons of financing. The other is a second set of eyes. Let's face it, most people that buy a business, and even maybe when you purchased your business, were a little bit skeptical of what a seller might be telling you. Are they telling you the truth? Are they just saying stuff so you'll buy their business? Is everything fraudulent? Well, there's really no way to tell unless it's third-party verified. When a third party comes in and verifies a lot of these items that may be concerning, it puts a lot of the burden of proof off of what is being initially represented from one party. It goes to a third party. A bank will not approve an SBA loan without doing some form of due diligence and verification of those financials. That in and of itself, although you still want to do all of your due diligence with your full team, which includes your accountant, your attorney, your appraisers, any consultants you might be working with, and of course your brokers, it does help when you have a bank which is actually writing the check for at least 80% of the purchase price, that they're standing behind and saying, yes, this is a profitable business. We've seen the financials that verify those financials, and the business will support this debt payment as a going concern. Those are three very strong items. Now, there's a whole host of items outside of that will assist in selling your business, and there's various ways and various methodologies and various strategies and various techniques that each individual business broker, or even if you're doing it on your own, will look to encompass to make the business sale actually happen. But the point of this webinar was to highlight the three, what seem to be very obvious and elementary items, but are overlooked by so many, and a lot of people get frustrated on how their business isn't selling. When you look at those three items, try to only offer your business for sale when you have those three items in place. If you don't have those in place, look to hire a professional team or do some self-study and able to get your business to a point where you have those three items. When you do, you're really going to increase your odds of success in getting that business sold, and hopefully for top price. I hope this webinar helped you in some way, and I hope it brought some enlightenment on maybe some of the aspects. You might be looking to sell your business now, maybe in the future, maybe plan, or maybe just looking at various options. Everybody's situation is completely unique in nature. It's individual. There's common metrics on how things are done, but it's unique to you. If you'd like to speak to us about what may be right for you, might be wrong for you, or just want another point of view, feel free to give us a call. We'll leave some links below, and also we'd like to offer you some other avenues that will enable you to possibly move forward with selling your business either now, in the future, or simply just out of curiosity. Out of all the business calls that we get, we start with an initial complimentary, free of charge, no obligation, no pressure, just initial call. On almost every call, the most common question that I receive is, how much is my business worth? That makes so much sense, because when you think about it, when you sell a car, you probably can go to the local dealership, or you can go online and get a real good idea of what your car's worth fairly quickly. Same thing with a house nowadays. It's quite quick as far as how rapidly you can get a response on what your house might be worth. Yes, it'll be a range, but it's pretty close. It's not like that with businesses, because there's so many variables that happen, and there's not a clear sense until there's a full review of the financials. However, with that said, when you're working with people that have been in the business for a very long time, whether it's our firm or any other firm, there's the tools and the comparable sales and a lot of the avenues that we've looked at that can say, okay, we're probably within this range. We can probably narrow it down after we do a review of the financials. But to get an overall range, which is pretty much in line of what you normally should expect, you should speak to a business broker. It's probably the quickest way that you'll really get a good idea of what your business is worth. Now, you can do a full business appraisal. These will range in value. On the low end, they're about $2,000. Most firms are going to charge $3,000 and up. If you have it very, very detailed, it could be upwards of $25,000. But a more cost-effective and efficient manner is doing what's known as a broker price opinion. These are not business appraisals; they are broker price opinions, known as business evaluations, and they are normally very economical, a few $100s. Probably most you'll pay is about $1,500. Some of them will do them free of charge. If you'd like to talk to us about it, feel free to reach out. We have all different types of packages that are available, and they're very, very cost friendly. And we can give you a general range complimentary on an initial consultation. The most important thing we wanted to get across in this webinar, and I'll end the webinar with this statement, is we just want to give some value added to the community. It's been such a crazy year this past year in 2020 for so many. I can't even express it in words. We all need to hope for a brighter future, and that things are going to not just get back to normal, but hopefully we learned and grew from the challenging time that the entire world has been through in this past year. So in 2021, we're really hoping that we can bring some added value to that entrepreneur community. And most importantly, and what our motto here is keep that entrepreneur spirit shining bright. So if we can be of any service to you, feel free to reach out, leave a couple of offers. If you like to use those, fine. And if you like to just reach out to us, that's fine too. And whatever your choice is going forward, we wish you the best going forward, and the best for 2021. Thanks again for joining this webinar. Have a great day.